We got to start with coal. Coal is
the senator?
Not the senator from Wisconsin.
The Burning Rock.
The Burning Rock.
Okay.
The day in coal is pretty significant because Peabody Energy is the largest coal company in America, and it has filed for bankruptcy. And first quarter revenue for CSX, the railroad operator, came in lower than expected because coal shipments fell 31% year over year. I'm sensing a theme. I mean, if you're an oil company or someone who invests in oil, is that the solace you take? Well, at least we're not coal.
So this was not a hard one to see coming, and I say that because Peabody lost $110 a share last year.
And they don't have like 6 shares. They've got way more. Yeah.
Well, they had a reverse split. So a 15-to-1 reverse split recently, so the shares had gone down. But losing $110 a share when you're a $2 stock is a bad math equation. And the equation was basically they sold about $5 billion worth of coal last year, and they lost $2 billion in the process, which is not something you can keep up.
Some of that's write-downs, though. Like, that's not all cash, but it is enough.
It's a grim equation and has been for a while for coal, and I don't see it getting better anytime soon. But if you're in bankruptcy, at least you can straighten out some of your debts by not paying them.
Yeah, for sure. The thing that I don't really, the thing that I cannot figure out, the thing that doesn't make sense to me, which means I'm probably not thinking about it right, which my wife tells me happens all the time. Coal is basically being replaced by other fuels. You know, utility slates have changed. Natural gas is the easiest place to go. Natural gas prices are nearly as far down in the dumps as met coal prices. And it is simply something that doesn't make sense to me how that would be the case.
Why are shares of CSX up around 5% today? I get that from the standpoint of their quarterly profits, they did just fine. They did about as expected. But clearly, the transport of coal is a significant part of their business. That is very much on the decline. Where is the enthusiasm coming from for this business?
So coal as part, and it's a huge part of the rail business, is moving coal, especially for CSX and some other companies. But that coal was down 31% year over year in volume. So
from not a very high number to start with.
Yeah, already declining. And I think that CSX, it's certainly not that number, or that number was expected. Coal is not reversing, but the monthly numbers were better than expected. I think Genesee and Wyoming had its monthly numbers out. It's up more than CSX today. So I think that on the whole, rail transport is beginning to show a little bit of life coming back. The stocks have all gotten clobbered, as most things in the transport sector, but everything has come back a little bit. And on the whole, although the quarter just passed doesn't look all that good, there are things since the end of the quarter that look better.
So at Fool Funds, we don't spend a whole lot of time thinking about daily movements, but Bill, try this on for size. The fact that Peabody has gone into reorganization rather than liquidation perhaps suggests that they may have some additional financial flexibility moving forward, and perhaps that's that would have something to do with the because coal is not. Although I would not call coal a growth industry, there's going to be many, many years in which coal is being moved in large, in rail cars around this country. It is simply the case that it's a big part of the slate for utilities. So I kind of wonder if some of it has to do with the fact that Peabody is finally attempting to get its financial house in order in a greatly reduced state.
I think that the rails are a diversified industry, moving a lot of things other than coal. So
frozen concentrate orange juice, for example?
Yeah, sure. We actually, when we go outside here, we're right by a major rail line, and boy, we see a lot of frozen concentrated orange juice cars go by us, which sort of detracts from the atmosphere of a nice spring day.
A massive rail coming by.
Somewhat.
So, Cole, I don't know of anything else that probably any industry that more squarely is going to be affected by the outcome of this election than coal. And I've said that before, maybe here, but you've got very, very different philosophies between the Democrats and Republicans on coal. Just the question, coal, one word, good or bad.
Yeah.
There is a 100% chance that you can predict coal, good or bad. That's you're only allowed to say one of those two words. Democrats will say bad, Republicans will say good. Now, they don't ever answer things in one word, so it's
Neither do you.
Yeah, unfortunately, coal is going away, blah blah blah, but we're going to help and all that. But really, this is an industry which is paying a lot of attention to the election.
Yeah.
Morgan Housel and I talked about Valeant Pharmaceuticals yesterday. Bellman, you've written recently about one of the stories related to Valeant is less about Valeant itself and the fund it took down with it.
The one of many, but one in particular is called the Sequoia Fund, and it's run. It is run by an asset management firm named Ruane, Cunniff, and Goldfarb. And Bill Ruane was the patriarch of this firm, and he was one of Warren Buffett's best friends from business school. So when Warren Buffett shut down his partnership 45 years ago now, that was his suggestion. If you want someone who invests like me, go to the Sequoia Fund, go to Bill Ruane. So they have a very, very long and august history. But they also had 31% of the Sequoia Fund in Valeant Pharmaceuticals. 31%, which is not something that we can even do. We are regulated as a diversified mutual fund. There are also non-diverse mutual funds, of which Sequoia was one. But 31% of in any one name means that not only are you are betting everything on nothing bad happening. Like, you're betting on your analysis being right. You're also betting a lot on chance. And it's kind of a dirty secret about investing, that a lot of it does have to do with chance. And when I look at a company or I look at a fund that has that much in one name, I get the sense that there was a breakdown in process. And that's what's exactly happened. Like, the principals of the firm have resigned. Board directors have resigned. They've come out and said, we're going to change how we do things from here on out. It's too late. I mean, it's really, really too late. And so you have a 45, 50-year history of really good investing, and it's been destroyed by not even one bad decision, but a process that's probably gotten a little bit sclerotic over time.
I bet on the way up, it was nothing but a party atmosphere as Valeant was on its way to becoming the largest Canadian public company.
Yeah.
And I'm always curious about what happens behind closed doors. Was there someone in the room saying, look, this is great, but we really need to take some of this money and put it somewhere else?
They were, and not only did they not take some off the table, but they kept buying, right? It wasn't like they bought an 8% position and then it became a 31% position in the awesome way, which is the way that anyone who ever invests should hope happens. Instead, they were buying all the way up. So not only did they undo by virtue of not taking some off the table, I seriously doubt they have a positive return from, on a dollar by dollar basis, even on a Canadian dollar by dollar basis, from when they started.
Well, the next chapter for Valeant is going to be interesting, given the possibility that it's going to have to shed some assets in order to eventually pay down I think it's got about $30 billion in debt.
$30 billion in debt. Yeah.
And the most frequently named solution to that problem is to sell off Bausch & Lomb, and which is, you can find a lot of different guesses as to what that might be worth. Certainly above $10 billion, and that would go a long way.
I wouldn't say certainly. I mean, on a revenue basis, but one of the things that Valeant's strategy has always been I mean, this was their business strategy: go and buy assets like this, and then strip out a lot of the R&D and strip out. So yeah, there's a cash flow stream, but I'm not sure that you could call
Bausch & Lomb is a reasonably. I mean, they don't need to have a lot of R&D. Although if you don't have R&D in the contact lens industry and you fall behind, it's a killer. But they're the number 4 player globally, and it's a stable business, cash business. That is something they can do. That's a trick up their sleeve.
Yeah.
There are plenty of real assets in Valeant besides Bausch & Lomb, but that's the one that gets mentioned the most frequently. And I think Bill Ackman, who's played a lot of behind the scenes work with this company, is saying that's not something they're going to divest. I don't know if he's got the power yet to make that call, but I don't know. Let's see what happens.
Yeah.
At Market Foolery is our Twitter handle. You can hit us up with questions there. I got a question from StuCat31 who asked, do you think dividend stocks for a young investor is wise? None of us are young investors, but
why you got to go there?
I'm just saying.
Is it because we're on video today and we can't hide the fact? Whereas normally, the listeners could entertain the notion that
we need stunt doubles.
Do you think that's happening? Do you think there are listeners who have heard this podcast over the past few years and thought, oh yeah, those 3 guys, they're easily in their 20s?
Hope so.
Yes, the answer is yes.
No.
The question remains.
The mysteries are gone now.
Yeah, exactly.
But not that we're advocating anybody watch the video.
No. But if you are in your 20s or 30s, does that make sense?
I'll be honest, I don't really care about dividends. There's actually...
And you've been investing since your 20s, so I'm assuming like when you were in your 20s, you were like, no. But even now...
there is a theory, and we're going to start talking financial theory, so this is fantastic for a podcast.
Honey, come quick.
Yeah, run on in. The dividend irrelevance theory, which is really what I want from a business, is that they do good things with their capital. And if they don't have good things to do with their capital, returning it to shareholders through buybacks or through dividends is perfectly legitimate. But whether a company pays a dividend or not, for me, is largely not that relevant. I mean, I think it becomes relevant for people as they grow older and would like a stream of cash coming back to them in a fairly tax efficient way. But buy good companies. Whether they pay dividends or not doesn't matter all that much.
Well, I think that young investors should not exclude dividend paying stocks, because there are many great ones, and it is sort of part of a complete, portfolio to have companies that are not all taking all of their money and investing it in growth. If you do that, if that's your entire portfolio, I hope you're young, because
you're going to visit some places.
Yeah, there are some times when that's going to go wrong, but that is how many young people might think they are supposed to invest, is buy some explosive growth things, because if they explode, then you've got 30, 40, 50 years left to make the money back, which is true, and it is a reason to take on more risk when you're young. But a lot of the great companies out there have been around for 40, 50, 80, 100 years and don't need to take all of their profits and constantly try to grow the business at explosive rates. And so paying a dividend imposes a certain amount of discipline, and it relieves management of some of the pressure of constantly looking for ways to keep the growth machine going. And so if you're only left over, if say you're paying out, you've got a payout ratio of, I don't know, pick a number, 40%. So you're paying out 40% of your profits every year to shareholders. You've only got to figure out what to do with the other 60%. That's easier on management than taking 100% of the profits every year and saying, how do we keep this high growth equation going? Yep. So there are a lot of great companies that pay dividends, and absolutely young investors should be looking for not just big risky bets, but great companies of all stripes.
But I think that's one of the things that's changed over the last 15 years or so, is the perception of dividend stock. I just remember when I first started investing and I was in my 20s.
So you've changed in 15 years.
Yes.
The perception.
No, I think the perception of dividend stocks was big, stodgy, unimaginative, and almost completely lacking in growth.
Yeah.
And we've seen plenty of examples over the last decade of companies that are able to establish healthy growth patterns, have market-beating returns, and oh, by the way, they also pay a dividend.
Yeah, that's Costco. I mean, what you've described is Costco, and I remember suggesting, I guess 15 years ago now, that Costco was one of the most innovative companies in America, and like they have, they're not a .com. They're not doing really cool things. They're not from Northern California. How could they possibly be innovative? And I do actually, to Bill's point, I do think that having a dividend and having a statutory dividend does give companies some discipline. And if you were to ask me if I wanted a slate of dividend-paying stocks versus a slate of mega high growth stocks, I'd take the dividend stocks every time. Every time.
Yeah, the best stock over the last, it's either 40 or 50 years. I don't think it actually matters pretty much what time period you're talking about, is Philip Morris. And that has been paying dividends all the way. I mean, that equation assumes you took the dividends and reinvested it in the stock, et cetera, et cetera. But, the many of the great growth stocks over the last 40 or 50 years have paid dividends all the way. And then you need to reinvest the dividends for the maximum return on that kind of an investment.